Yeah, I mentioned those inflation numbers that will really be front and centre stateside later on tonight. A year-on-year number, something like a more than 5% gain. So those inflation pressures not going away. What is it going to mean for policy normalisation? Is it coming soon, and how do you invest around that?
Yeah, it's a real test of the Fed's new flexible average inflation targeting framework. So we're really looking for September for further guidance as to how it's actually going to work, because there doesn't seem to be much of a consensus coming out from the Fed members at the moment in terms of whether tighter policy is most appropriate or whether easy policy should remain. So we think that whilst the pressures that we're seeing at the moment will undoubtedly be transitory, we're watching very, very closely to see if there are elements of the higher inflationary numbers componentry, which may indeed be more sticky. And for that, we're really looking at wage growth and whether we're going to see minimum wage pressures start to build. That's something that we're paying a very close eye on, and may actually result in the Fed having to be a little bit more hawkish than they're currently pursuing at the moment.
So how does that then influence your investment strategy, particularly if you're looking at Australia, the Asia Pacific, and ultimately the United States as well?
Yeah, it was interesting. So when you're looking across the board, we're underweight duration in our multi-asset portfolios. We don't think that now is an appropriate time to be taking interest rate risk in your fixed income portfolios. So underweight duration. And we also are deeply underweight inflation-linked assets with real yields bumping around their all-time low levels, particularly in the US, minus 1% real yield on the 10-year there. So we think that it's more appropriate to take risk in the growth parts of your portfolio, looking at equities, but it is a time when the market is transitioning from early cycle to mid cycle. So look out for more defensive names, more defensive type sectors. And we've obviously seen some of the rotation from growth to defensive assets start to come under pressure, particularly in more recent months, as bond yields have started to collapse, with the market assessing that potentially we have come through the peak of reopening and stimulus measures at this stage in the year.
When it comes to multi-assets away from equities, what's your preference there?
So we don't like investment grade credit today, with spreads being at all-time tights. So not a lot of value there. And there's also been a considerable level of deterioration in the overall index. So a lot of BBB rated names within that index as well. So we don't think you're getting much compensation there for taking credit risk. But we are happy to go overweight global high yield, and in particular Asia high yield, where spreads are much higher, particularly given some of the concerns that you've seen around China and the sell-off in the equity market there. That spread through and bled through into the high yield market as well. So we think that the recent sell-off has presented opportunity for long-term investors, value investors, to actually get some pretty nice allocations to this space. But we undoubtedly acknowledge that the next 6 months or so are going to be more volatile than investors have become used to, because of the rise of the Delta wave of COVID-19, and also in an area of Asia where there are lower vaccination rates amongst some of these nations as well.